Welcome back to another episode of Palisade Radio. This is Colin Cattell. Returning on the show today is my good friend Jordan Roy-Byrne. He's also the publisher and editor of The Daily Gold. Jordan, welcome back to the program.
Colin, thanks for having me on. How are you today?
I'm great, and I just want to extend a thank you to you from myself and many of our subscribers. You've been putting up these weekly or every other week a precious metals market update, and they've been getting a lot of traction and providing a lot of insight into the market. And as a result of that, we haven't been having you on for an interview as often, but I wanted to get you on today to discuss a few different things, so thank you for that.
Oh, well, you're welcome. It's a pleasure to do that. I really enjoy it.
Well, I think the most pressing thing to talk about is your new book. And it came out last month. It's called The Coming Renewal of Gold's Secular Bull Market. The subtitle, Dump U.S. Stocks and Prepare for Gold's Final Run. The title is pretty self-describing of the thesis of your book, but what can you tell us about why you think that gold is going to have this final run? Just a couple minutes on the book.
Well, gosh, Colin, I could really go in great depth as far as your question, but very simply, in the book, I talk about what really drives gold, and that's negative real rates and negative real yields. I mean, you can look at the Fed funds rate and also the yield on the 2-year or 5-year Treasury bond, and essentially, gold does well when you're not receiving a real return on these instruments. So in other words, let's just say, generally speaking, you have your money in the bank or in your brokerage account, you own a short-term 2 or 5-year Treasury bond. If inflation is 2 or 3% and you're only getting 1% on that security, you're essentially losing money in real terms. You're getting a negative real return. So that's really and if you look at these things on a chart going back 50 years or 100 years, the picture really explains why gold moves the way it does. I mean, to give you an example, the last couple years, the rate of inflation has gone down and yields have actually gone up a little bit. So over the last couple years, there's been less incentive to hold gold because of the changes in inflation and interest rates. So that's really what drives gold. And I think when as far as why I think we're going to have a final run and why things are going to turn around, I have one chapter on that. But specifically, when governments get into a situation where they have too much debt and it's affecting economic growth, and really the way to get out of that is inflation. That's what happened in the 1940s. And so essentially, with governments having these huge debts and they want to get inflation, they've been having difficulty getting that inflation. But the policy is basically to have negative real rates or negative real yields. And essentially with this huge debt, if they were to raise interest rates too high or too fast and not get the inflation, then the burden of that debt becomes more burdensome, for lack of a better description. So when people talk about inflating the debt away, the way to do that is to have, one term for it is financial repression, but you're basically keeping rates really low and hoping that inflation will pick up. And so, we've had disinflation in the last couple of years, which is negative for precious metals. And I don't think that's sustainable. We're going to get into a situation where either the economy is going to perform better and they're going to let inflation run. They're not going to see, even if they raise rates 25, 50 basis points, or even to a point in the next year or two, if inflation goes up more than that, that's what's bullish for gold. And I think in the other scenario, where if you think the economy is going to slow, they're obviously going to print a lot more money and try and somehow force more money into the economy to get that inflation. So essentially, when you look at these things in the really big picture, we're going to have to continue to have negative real yields going forward. Governments will have to continue that policy until they get debt and debt burdens under control. So that's really why, in my opinion, as far as the secular view of gold and secondarily resources, why we're still in a secular bull market and why I expect things to turn around.
Many gold investors talk about inflation. It's been the key word for the gold bull market since 2000. And what your book very effectively does with charts is you're able to go back over the last century and show the reason that causes inflation are these negative real rates. People seek gold because they're actually losing money by sitting on their cash until they'll make more money or at least preserve it by being in gold. So I would suggest all of our subscribers go and take a look at Jordan's book. I'll provide a link in the description of this video. Jordan, I want to move on and talk to you about gold. Before we hit record on the interview, and last week you told me you want to come on because you really think gold is going to hit a new low here. In fact, you said that last week at 1160, it was only 1% away from hitting a new low. So why do you think gold is going to hit a new low?
Well, Colin, I know we've been doing these interviews for a couple of years, and it kind of seems like Groundhog Day, where every time gold has gone down, I've been saying, it looks like it's going to break down. At this point, there's a couple reasons. I mean, first of all, looking at both gold and silver, they kind of have this 7 or 8 month base of support. So that sets up that if gold and silver break below these levels, that's going to give it more downside momentum. Another thing to keep in mind is volatility in precious metals has been contracting over that time period. And usually when volatility is going down, it can only go down for so long. And then when it starts to pick up, you get a sudden change. So it's ominous that we're nearing these supports with really low volatility. And then in addition to that, if you look at the commitment of traders data in both gold and silver, if you look at and I measure it as far as what's the net speculative position as a percentage of open interest in the market. And if you look at that, the lows of the last couple years for gold were around 6%. It hit that a couple times. I believe silver hit 4 or 5% at one point. So those were the readings when these markets hit important lows over the last couple years. As of last week, the readings on that were 27% for gold and 31% for silver. So we know that we've been in a long bear market. Sentiment is really bearish. That's true in the big picture, but really drilling down and looking what's happening right now. If you look at the traders in the market, in the futures market, who are buying, selling, shorting gold and silver, the speculative component of the market, again, 27% for gold, 31% for silver. That's just really ominous, because if we do start to move lower and we break those levels, a lot of these people are going to have to sell, and these figures tell us that there's still a good amount of speculators left in the market. If it was much lower, if it was below 10%, then we'd have to be wary that we might get a low, but that's not the case. These are just too high. And also the price action of gold and silver in the last couple days to the last couple weeks, it's just really been weak. It's been bearish. So it really looks to me like we're setting up for the metals to break down, and I think it's going to happen in the next couple weeks. I think we're setting up so that July could be an ugly month, and obviously it's just a guess, but I think we could see the breakdown either next week or the week after. If I had to guess, I think it's going to happen before the end of the month. So I mean that's how I see things. It just looks like the next couple months could really be difficult for the metals. But look, if you have a time frame beyond the next 2 or 3 months, things are going to turn around after that. But we're going to have to let this pain happen first.
Volatility in gold, as you just pointed out, very low right now. Volatility in the stock market, meaning the Dow Jones and S&P, also quite low. However, most people don't follow the bond market. Volatility has been picking up dramatically there. The German bonds in Europe have gone from 0.3% to 0.9%. Japan and the US both ticking up as well. Do you see any relation between the bond markets and the currencies having this high volatility and gold and silver having low volatility?
It's a very interesting question, but I would say not really. I think if you look at what's happening in Europe, usually when QE happens, before QE, the rates go down, and then when they do QE, rates go up or bonds sell off. So I think that kind of explains what's happened in Europe. And with respect to the U.S., I should say, and Japan, I mean, rates got really low. We've had a big bounce in rates and a decline in bond prices. I, with respect to the U.S., I actually think that we're going to see bonds rise again and yields go down again. I mean, looking at the stock market, it looks kind of toppy. And if the stock market starts to correct, remember, it's gone a really, really long time without having a 10% correction. So it's really overdue to have a 10 or 15% correction. And if that happens, money is going to go back into bonds. So I know I probably disagree with some of your other guests, but at least in the months ahead, I think yields are more likely to move lower than continue to move higher. Given that situation, we could see precious metals start to move lower and have higher volatility. But I'm not sure they're really related at this point. I do think with the Fed, as a gold bull, I want to see the Fed raise sooner rather than later because I think, remember, the market peaked when the Fed did the last QE. I think when the Fed raises or starts to raise, I think you're going to see the precious metals are going to do well. So I think the sooner they raise, the better. And I think yields have gone up a little bit because they're assuming that the Fed is probably going to hike at some point. And also, that could be the fundamental reason that perhaps drives precious metals down to these final lows. Yeah, so that's it's an interesting question, but those would be my thoughts on how they're potentially related.
Okay, and back to the gold. I want to go back to gold, but this time with gold stocks. You see a new low in gold. What do you see going on with the gold, silver stocks?
Well, it's very interesting, and we were talking about this beforehand, and you can look at the Huey or the GDX for the large stocks, and then GDXJ for the juniors, but kind of the larger juniors, as the smaller juniors are not really represented in GDXJ. But looking at the Huey versus GDX, GDX is based on an index which has a lot more companies in it, and also GDX has some royalty companies in it that have obviously been much stronger over the last couple of years. So that explains why the Huey has been a lot weaker than GDX. Looking at the Huey, I mean, that looks ugly. I think it's going to make a new low. But Colin, I really want to talk mostly about GDXJ because that's really been holding up well in the last couple of weeks. If you look at a chart of GDXJ versus GDX, I think yesterday that hit about a 5-month high. So the relative strength of the juniors versus the seniors, I mean, that's a good sign for the whole sector. And it's very interesting considering the market is getting weak, and you'd think the more speculative areas, such as GDXJ, would lead to the downside. I mean, it normally would do that. But the fact that GDXJ is showing relative strength here, I mean, that's an indication to me that, we're nearing the end of this bear market and that the juniors have discounted most of, or perhaps even all of the weakness that we've seen in metals in this bear market. I mean, we know that the stocks have a tendency to lead. We know that the juniors peaked 5 or 6 months before gold in 2011. So these things kind of explain the relative strength in GDXJ. But if you look at a weekly chart of GDXJ and you look at the volume, it's kind of had 3 lows over the last 7-8 months or so. And that first low was in October, November, late last year. There was a huge volume explosion in the weeks around the low. Then the next low was in December for a couple weeks. The volume on that sell-off was less than the first one. And then the most recent low was in March, where GDXJ just printed a new low. It barely did over the December or below the December low, I think by a couple cents. But on that, the third low there in this series, volume surrounding that low was again much lower than those previous 2 lows. So we're seeing less selling and less selling as the market has come down to these levels. And I think the lows are around 21, 22 in GDXJ. It closed just above 25 today. So it has about 15% downside or so coming down to that low. It's tough to say, but I wouldn't be surprised if GDXJ did not make a new low and held its lows there. Again, looking at the Huey, looks like it's going to make a new low. GDX, I'm not sure. Maybe it'll make a marginal new low, but I'm more focused on GDXJ right now because of the relative strength and because of the fact that the selling based on the volume on the chart has just been it's been less and less over the last 7 or 8 months. So I think that's very interesting and something to keep in mind. And just the last point on this, Colin, if the metals do make new lows and sell off, the miners are clearly going to get hit, but it's just a question of how much are they going to get hit and when are they going to start to turn around. And that's something that I'll continue to watch. But just from a relative standpoint, I like how GDXJ is setting up here. And I think if it trades down to that 21 or 22 area, I think that's a great time to do some buying.
Well, Jordan, a lot to think about. Thank you for coming back on the show. And once again, the coming renewal of gold secular bull market is available on Amazon. We're going to provide a link. It would be great to show your support for Jordan, and his book is a great read. Jordan, thanks for coming back on the show.
Colin, thanks for having me.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen? Or are you too stupid?